So, so good morning, good afternoon, and good evening to whenever you're seeing this. My name is Jerome Hovero. I am going to read to you the principle of portfolio selection and efficient markets and the equity market. So, first up is the equity market. Equity as a source of corporation finance. Equity financing is the process of raising capital through the sale of shares. Companies raise money because they might have a short-term need to pay bills or they might have a long-term goal and require funds to invest in their growth. By selling shares, a company is effectively selling ownership in their company in return for cash. Equity financing is used when companies, often startups, have a short-term need for cash. It is typical for companies to use equity financing several times during the process of reaching maturity. There are two methods of equity financing: the private placement of stock with investors and public stock offerings. Equity financing differs from debt financing. The first involves borrowing money, while the latter involves selling a portion of equity in the company. National and local governments keep a close watch on equity financing to ensure that everything done follows regulation. Preferred versus common. The main difference between preferred and common stock is that preferred stock gives no voting rights to shareholders while common stock does. Preferred shareholders have priority over a company's income while they are paid dividends before common shareholders. Common stockholders are last in line when it comes to company assets, which means they will be paid out after creditors, bondholders, and preferred shareholders. Primary versus secondary. The primary market is where securities are created, while the secondary market is where those securities are traded by investors. The primary market, companies selling new stocks and means bonds to the public for the first time, such as with the initial public offering. The secondary market is basically the stock market, and the defining characteristics of the secondary market is that investors trade among themselves. The price earning ratio, or PE ratio, relates a company's share price to its earnings per share. A high price earning ratio could mean that a company's stock is overvalued, or else the investors are expecting high growth rates in the future. Companies that have no earnings or that are losing money do not have a price earning ratio, since there is nothing to put in the denominator. To, to solve or calculate for such of the price earning ratio is for the market value per share to be divided on earnings per share. The stock market. Stocks or shares of a company represent ownership equity in the firm, which gives shareholders voting rights as well as residual claim on corporate earnings in the form of capital gains and dividends. Stock markets are where individuals and institutional investors come together to buy and sell shares in a public venue. Share prices are set by supply and demand in the market as buyers and sellers place orders. Order flow and bid-ask spreads are often maintained by specialists or market makers to ensure an orderly and fair market. A stock or share, also known as a company's equity, a stake in the company, is a financial instrument that represents ownership in a company or corporation and represent a proportionate claim on its assets, what it owns, and earnings, what it generates in profit. Monetary policy. Monetary policy refers to the action undertaken by a nation's central bank to control money supply and achieve sustainable economic growth. Monetary policy can be broadly classified as either expansionary or contractionary. Expansionary monetary policy, the monetary authority often lowers the interest rates through various measures serving to promote spending and make money saving relatively unfavorable. Contractionary monetary policy, increasing interest rates and slowing the growth of the money supply, aims to bring down inflation. This can also slow economic growth and increase unemployment, but is often necessary to cool down the economy and keep it in check. Next is the principle of portfolio selection and efficient markets. Uncertainty, expected return, and risk. Risk management is the process of identification, analysis, and acceptance of mitigation of uncertainty in investment decisions. Risk is inseparable from return in the investment world. Expected return is the amount of profit or loss an investor can anticipate receiving on an investment. An expected return is calculated by multiplying potential outcomes by the odds of them occurring and then totaling these results. Expected returns cannot be guaranteed. Expected return for a portfolio containing multiple investments is the weighted average of the expected return of each of the investments. Expected return can be calculated by risk-free premium plus the expected market return less the risk-free premium. Risk management occurs everywhere in the realm of finance. Stockbrokers use financial instruments like options and futures, and money managers use strategies like portfolio diversification, asset allocation, and position sizing to mitigate or effectively manage risk. Selecting a portfolio. A portfolio is a collection of financial investments like stocks, bonds, commodities, cash and cash equivalents, as well as their fund counterparts. A portfolio investment is an asset that is purchased in the expectation that will earn a return or grow in value, or both. A portfolio investment is passive, unlike a direct investment, which implies hands-on management. The composition of investments in a portfolio depends on a number of factors. Those with greater risk tolerance may favor investments in growth stocks, real estate, international securities, and options, while more conservative investors may opt for government bonds and blue chip stocks. Efficient portfolios and risk return trade-offs. The risk-return trade-offs is an investment principle that indicates that the higher the risk, the higher the potential reward. To calculate an appropriate risk-return trade-off, investors must consider many factors, including overall risk tolerance, the potential to replace lost funds, and more. Investors consider the risk-return trade-off on individual investments and across portfolios when making investment decisions. An aggressive portfolio takes on greater risks in search of greater returns. A defensive portfolio focuses on consumer staples that are impervious to downturns. An income portfolio concentrates on shareholders' distributions. The speculative portfolio is not for the faint-hearted. The hybrid portfolio diversifies across asset classes. The efficient market hypothesis. The efficient market hypothesis, or theory, states that share prices reflect all information. The efficient market hypothesis hypothesizes that stocks trade at their fair market value on exchanges. Proponents of the efficient market hypothesis that investors benefit from investing in a low-cost, passive portfolio. Opponents of efficient market hypothesis believe that it is possible to beat the market and that stocks can deviate from their fair market value. If EMH is highly controversial and often disputed, Believers argue it is pointless to search for undervalued stock or to try to predict trends in the market through either fundamental or technical analysis. Theoretically, neither technical nor fundamental analysis can produce risk-adjusted excess returns consistently, and only inside information can result in outsized risk-adjusted returns. So with that, thank you for listening.